Welcome back to PlanB on YouTube. Today we talk about Bitcoin models, and there has been a lot of discussion lately about Bitcoin models, so this is my 2 cents. I will talk about 4 models, the pros, the cons, how to use them, and insights for the Bitcoin price. So this chart shows 4 valuation models based on time, stock to flow, UTXO, and difficulty. Now before we go into the details, I'd like to address one thing. These are valuation models, and value is not the same thing as price. Many people think about models and they think they're wrong because all prices are determined by supply and demand. So if demand is not in the model is worthless. And although that is of course true, we are not talking about price. We're talking about value. And the famous investor Warren Buffett always says, price is what you pay, value is what you get. And I want to give an example of the difference between price and value. So, for example, if you want to value a company, your own company, you can do that with a very simple price earnings model. So you can take a look at the earnings, which, for example, are 100K per year, and then the price earnings model says, okay, you have to. The value of the company is a factor of those earnings. For example, the factor of 5. So if the earnings are 100K, the value of the company is 500K. And of course, that can be very different for other companies. Some companies are valued at 10 times the earnings, and S&P 500 companies are valued at 20 times the earnings. But anyway, let's take the 5. So the company is valued at 500K. If you can buy that company for the price of 300K, you have a great bargain. You buy something for the price of 300K and its value is 500K. So there you see the difference between price and value, and all these models are valuation models. So if you like my videos, by the way, please subscribe by pushing the button below so you don't miss anything and you support me. Okay, first model, time model. That's the light blue line here, the very smooth light blue line. It's at the moment around 70K, and time, of course, is an approximation for adoption. That goes over time, more adoption of Bitcoin. And the logic then is that the price increases as adoption increases over time. It's a very basic model. It's a trivial model, and it's also the oldest model that I know of. A very famous one was 2014. A guy named Trololo had a very nice chart, and you might know his models. But there was even an earlier variant in 2012. The most recent variant, I think, is the rainbow model that shows that same logarithmic upward sloping curve, but that's basically a time model as well. I implemented here a power law model, which is basically the same thing. Now the second model is the stock to flow model, and the stock to flow model is quite similar. It's a dark blue line, quite similar to the time model. However, it has some jumps, and the jumps are, of course, the halvings. It's at 60,000-ish right now, which is quite similar on the log scale, of course, as the time series model, the time model. And stock to flow measures scarcity by the stock to flow ratio, and the logic then is that the Bitcoin price increases as the scarcity of Bitcoin increases, and there's special interest, of course, for the halvings. Those are the jumps, where the price jumps and the model jumps as well. You see the 2012 halving here, and the price jumps right after that, model 2. 2016 halving, price jumps right after that, and the model 2. Same here in 2020. And the next halving, of course, will be in 2024, so we see the model already going up. Now, I created a model, the stock to flow model, in 2019. That was here. And it was very intuitive for institutional investors like myself, but also like Fidelity and Grayscale, Van Eck, who used this model in their investment presentations. And I must say, personally, I am invested in Bitcoin because of the scarcity, mainly the 21 million supply cap. That was the argument that did it for me. Now, some people have a very emotional reaction to the stock to flow model for some reason. They say it's invalid and it's broken. And that's because the price right now is under is very much below the model. But somehow, for those people, the time model is not broken. The stock to flow model is, and somehow in 2017 and 2013, when the price was very much above the model wasn't broken either, and the same also for the time model. So I guess the emotional reactions are more personal, maybe against myself instead of the model so much. But anyway, it's a frequently used model, and it's the dark blue line. The third model is based on difficulty, and difficulty in red is currently predicting 30,000, so it's spot on actually. It measures the network power, the power of the Bitcoin network, and it's very comparable to hash rate and the watts, eventually, the number of watts, the amount of watts the network is using. And the logic then is the higher the power, the higher the difficulty, the hash rate, the watts, the higher the Bitcoin price. And that's what you see over time. You also see very nice trends, like here, this very steep increase in the red line is because miners went from CPUs to GPUs to graphic cards. And another steep increase here is when the miners jump to ASICs, so mining specific chips, and from there on it's kind of, well, more flat, but it has a very interesting arbitrage relation, sort of make or buy decision. You can make Bitcoin as a miner with watts, with kilowatt hours, and then you pay a certain price. But you can also buy that same Bitcoin as an investor with dollars, and so there should be a relation, arbitrage relation between the two, because if the price is very much above the model value, the difficulty model value, then of course you're going to mine, and the difficulty goes up. And if the price is very much below the model, then of course you buy it as an investor, and then the price goes up. So very interesting, very economically valid, and well, it's the third model in this chart. The fourth model is UTXO. UTXO, it's a green line. It's at 24,000 at the moment, so it's the lowest valuation. UTXOs are the 112 million Bitcoin fractions that total the 19.4 million Bitcoins that are out there right now. That's the total supply. But of course, as you know, the total supply is not whole Bitcoins. You can have fractions of Bitcoins, and every time you transact a fraction of a Bitcoin into more fractions, the Bitcoins get distributed a little bit wider over more UTXOs. So it's the logic then is that the more the Bitcoin gets distributed over UTXOs, the more the price will increase. And you see it tracks very well. It even got the dip here in 2018 after the 2017 all-time high very well. But then, to be honest, I thought the UTXO models were sort of done, like the address-based models and the transaction-based models, because there's level 2 on Bitcoin right now with Lightning and Liquid. And actually, I thought until recently that those models were done, but then last couple of months we saw a sharp increase in the UTXO size to this 112 million, and thus a sharp increase in the valuation of Bitcoin based on the UTXO set. So it's very interesting where that increase will stop or if it goes on. Well, those are the four models that we're looking at, and to be honest, all the models did quite well in valuing Bitcoin and predicting the Bitcoin price. In my opinion, none of those models failed, and the big question is, however, how should we use them? And well, for me, how I use them is you can see at every point in time, let's take this point, 2017, you can see if Bitcoin is overvalued compared to the four valuations models, or if it's undervalued, like in 2018. So Bitcoin moves from the upper bound of the model, of all the models, to the lower bounds, to the upper bounds, to the lower bounds, and that this is sort of this movement. And if Bitcoin is in the lower bound of the models, then it's a great time to buy Bitcoin. And actually, we are currently in the lower bounds of all the models, and as, of course, if Bitcoin is above all the models, and that was very clear in 2013, 2017, then you should be wary. Like, where is this based on? Obviously not a factor in one of these models, not on time or stock to flow or UTXO or difficulty. Probably based on psychology, FOMO. So that's dangerous, and so that's one way you could look at it. You could also take the average of all the models. You could look at the ensemble, the average, which is now 47,000 if we do that for all the models. And what's also very interesting to look at is what should UTXO and difficulty be? Can those two models approach the time and the stock to flow models? And the answer is yes. So in order to do this, the number of UTXOs should rise 70% to 190 million. And then the pricing, the value based on the UTXO set is also in the 60-70K range. And the same for difficulty. If difficulty goes 4x, so that's quite a jump, but it can be done, right? It can be done, for example, based on the insight right now that Bitcoin is very good in balancing electricity grids. The load on those grids can be very peaked and cause problems, and Bitcoin can then switch off the miners and unload those high loads. And also, we see that Bitcoin mining now helps flared gases, oil rigs, to burn those gases and use it for Bitcoin mining instead of flaring them or emitting them into the air. And same with landfills. So the environment argument or the power grid argument could cause a sharp increase in difficulty, in hash rate, and of course a sharp increase in price would also make mining much more profitable, and more miners would enter the market. So 4x difficulty, 70% plus in UTXO set would sort of bring all those models together to the 60-70K domain. And well, the other important thing is in how to use those models. You can see that only the time model and the stock to flow model can be extrapolated into the future, because we know this was the first year, second year, this was the 13th year. We can just put 14 in this formula, or 15 or 16 or 17, and then the valuation based on time is known. Same for stock to flow. We know the halving is in 2024. We know what the stock-to-flow ratio will do. It will double from today's stock-to-flow ratio. And we can plug that into the model and derive a value. So only those two models can be extrapolated. And you can see that this is exactly where I got my 100K to a 1 million Bitcoin range from that I predict in the next halving cycle. So the 100K is more based on the time model, which is the lower end of that range. The 1 million, or actually this one is at 500,000, is more the higher bound of that model range. So how good are those models really? We could look at the goodness of fit, R squared, which is 97% for the time model, stock-to-flow model, and the UTXO model, and it's 94% for the difficulty model. But then R squared doesn't say anything, and I guess the very important thing to remember is correlation between those four factors and the Bitcoin price is not causation. The relation can be spurious, it can be incorrect. So you should always remember that. And also, I mean, those are very simple models based on one factor, so you can't expect those models to be 100% correct. 94 and 97% is actually quite good, and 100% would be impossible with these very simple models based on one variable. Some people even say that models are invalid and useless because variable X, Y, or Z is not in there. Like, okay, a demand is not in there, so the model is not useful. Or the dollar M2 money supply is not in there, so the models are not useful. That is not true. That's not true at all. I mean, yes, a lot of factors influence the price, not only those four factors. You have all the macro factors like the Fed and the inflation and interest rates and the money supply of the dollar. You have the SEC with their ETF approvals. You have exchanges that go bust like FTX recently. All those factors have an impact on price. But most of those factors are random events. The Russia war, who could have predicted it? The mining ban of Russia or of China in 2021, who could have predicted that? Those can't be modeled. What we are looking for in models is the bigger structural factors that play a role in the valuation. And modeling is therefore very much about generalization of order and not memorization of randomness, because randomness is randomness that cannot be predicted. We want the order of things. So what we do is we use something called ceteris paribus. It means all things equal, and we can isolate single factors, ceteris paribus, with keeping the rest, assuming the rest constant, and then look at what the impact is of one isolated variable like time, stock-to-flow, UTXO, difficulty. I like that very much, that approach. I mean, for example, stock-to-flow, scarcity. We know that all things equal, ceteris paribus, scarce assets are worth more than non-abundant assets like air or water. So gold is very scarce and valuable. What we also want in models is parsimony. So we want models to be as simple as possible, and we want to have as few variables as possible. We want to have straight lines instead of sinuses or logarithmic lines. We want to have simple models, parsimony. And so in the end, all the models are wrong by definition, because there is error. You can't model the random events. Indeed, you don't want to model the random events. So by definition, all models are simplifications of reality and are wrong. but some are useful anyway. Thank you very much. If you like my video, please subscribe so you don't miss anything, and of course you support me.